You think your money is safe in a bank? But what if the biggest risk isn't losing it? It's watching it slowly lose value without you ever noticing. This guy used to believe the same thing. To him, the bank wasn't just a place to store money. It was a symbol of control. A quiet, predictable place where numbers didn't move and nothing unexpected happened. $10,000 sitting in an account felt solid, like something permanent. No stress, no market noise, no uncertainty, just stability. This guy trusted that stability. Compared to the outside world, where people talked about investments going up and down, where financial decisions seemed complicated and unpredictable, the bank felt like the safer and smarter option. It didn't ask for attention. It didn't require knowledge. It simply held the money. For a long time, everything appeared perfectly fine. The balance stayed the same. Life moved forward. Bills were paid. The account remained untouched. And because nothing negative happened, this guy's belief became stronger. No visible change meant no risk, or so he thought. But quietly, something else was happening in the background. This guy didn't notice it at first because there was no immediate signal. No drop in balance, no alerts, no sudden loss. On the surface, everything looked identical, but outside the bank, the world was changing in a way that didn't wait for anyone. Prices began to rise slowly, not dramatically, not all at once, but gradually. Groceries cost a little more. Rent increased slightly. Daily expenses that once felt manageable started to require more money. Each change was small on its own, but together, they created a shift that was hard to ignore over time. His $10,000 was still $10,000. The number didn't change, but what that money could actually buy started to decrease. This guy began to realize something important, not through a sudden event, but through repeated small observations. The problem wasn't that money was disappearing. The problem was that its value was being affected by external forces. Inflation was doing exactly what it is designed to do, and while this guy had been focused on protecting his money from loss, he hadn't considered how money could lose value even while staying in place. That was the first major shift in his thinking. At first, this guy resisted the idea. It challenged his understanding of safety. He had always assumed that as long as the number didn't go down, he was secure. But now he was starting to understand that safety isn't just about avoiding visible loss. It's also about preserving value over time. This guy didn't react suddenly. He didn't make drastic changes. Instead, he began to observe more carefully. He paid attention to his expenses, comparing past costs with current ones. Slowly, patterns became clear. His money in the bank wasn't growing in a meaningful way compared to the rising cost of living. The interest he earned was small. It existed, but it wasn't enough to keep pace with inflation. On paper, his balance might have increased slightly, but in real terms, his purchasing power was falling behind. This guy realized something critical. The bank wasn't designed to grow wealth, it was designed to store it. That distinction changed how he viewed everything. He also started noticing people around him who approached money differently. Some were investing, some were taking calculated risks, some were placing their money into assets that had the potential to grow over time. At first, this guy saw those choices as risky. Investments fluctuate, prices go up and down. There's uncertainty involved, and no fixed short-term outcome. Compared to the stability of a bank account, it felt uncomfortable. But over time, he began to question his own definition of risk. Because while investments carry visible fluctuations, the bank carries a hidden one. This guy asked himself a simple but important question. Is something truly safe if it slowly loses its ability to support your future needs? That question didn't have an immediate answer, but it changed his perspective. He began to understand that there are two types of risk. One is visible, the short-term volatility of investments. The other is invisible, the gradual erosion of value when money remains idle while the environment continues to evolve. This guy had been avoiding visible risk without realizing he was exposed to hidden risk. And that hidden risk doesn't appear suddenly, it builds slowly over time. That realization pushed him to rethink his approach. This guy didn't abandon his bank account. He didn't see it as useless. Instead, he understood its purpose more clearly. The bank provided liquidity, accessibility, and short-term safety. It was useful for emergencies and everyday transactions, but it was not designed for long-term growth. That realization marked a turning point. This guy began to treat his bank account as a tool rather than a strategy, a place to hold money temporarily, not a place to build long-term wealth. He started looking into investing with a different mindset, not as something to fear, but as something to understand. Not as a gamble, but as a way to align money with long-term growth. At first, uncertainty still felt uncomfortable. Markets move, prices fluctuate, there are no guarantees in the short term. But this guy began focusing less on short-term movement and more on long-term direction. He studied how investments behave over time. He observed how patience, consistency, and informed decisions can influence outcomes. He avoided impulsive actions and focused on building understanding. Gradually, his perspective shifted. This guy began to see that growth requires exposure to uncertainty. Avoiding all uncertainty may feel safe in the moment, but it can limit long-term progress. He also noticed something subtle about behavior. When money sits in a bank, it becomes passive. There's no urgency, no decision-making, no engagement. It's easy to ignore. But when money is invested, it becomes active. It requires awareness, attention, and learning. It changes how a person interacts with their finances. This guy didn't see that as pressure. He saw it as awareness. Over time, he refined his thinking further. He separated emotional comfort from financial effectiveness. The bank provided emotional comfort because it eliminated visible fluctuations. But emotional comfort does not always lead to financial growth. This guy started focusing more on outcomes than feelings. He began asking a different question. What will my money be worth in the future? Not just what it is today? That question changed his entire perspective. Instead of seeing his 10K as a fixed amount, he began to view it through the lens of time. Its present value was only one part of the equation. What mattered more was how it would behave over the long term. This guy realized that time is a critical factor in finance. Money that is allowed to grow benefits from compounding and reinvestment. Money that remains idle does not. And when money sits in an environment where costs continue to rise, time works against it rather than for it. This guy didn't make extreme changes. He didn't abandon caution, but he redefined his approach. He kept his bank account for its intended purpose, storage and accessibility, and began thinking more intentionally about where his money could grow. The key change wasn't just in what he did, but in how he thought. He stopped asking, "Is my money safe right now?" and started asking, "Is my money positioned to remain valuable in the future?" That shift brought clarity, because in the end, this guy realized something simple, but often overlooked. The bank didn't fail him. It didn't take anything away. It didn't make a mistake. It simply performed exactly as it was designed to perform. It stored his money, nothing more. And that's where the misunderstanding exists for many people. They expect storage to also mean growth. But those are two very different functions. This guy's realization didn't come from loss or crisis. It came from observation, awareness, and a willingness to question assumptions. And once he understood it, his perspective changed permanently. His $10,000 was never at risk of disappearing overnight, but its ability to keep up with the world around it depended not just on where it was stored, but on how it was used over time. And that's the part most people never question until they finally do.